Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thanks for joining us today, Tuesday noon. We do our live weekly updates on everything that's going on in the markets and touching on other areas. And today, appropriately, I think we're going to talk about risk, both risk in portfolios and risk we see out in the markets. I apologize if you're watching live or on the replay later on. For some reason, my little window box here is glitching. I'm not sure if that's showing up on the video on your side, but it looks like the sound's coming through fine. So hopefully we'll go through that. And on the podcast, it should just be the sound. So it should be no issues. So as always, keep in mind everything that we cover off here is for information purposes only. Don't take, or if you're going to use any of these strategies or anything we talk about, do your own due diligence, or as always, go to mikeonmoney.com, reach out to us. Happy to answer any and all of your questions as it might pertain to your particular situation. If you are watching live, you can pose questions. Just click that Q&A button, type in your questions. We'll try to get to them today as we go through. Of course, if you're listening on the podcast or watching a replay on YouTube, just fire us an email or reach out to us. We'll answer all your questions. So with that, let's dive right into things. So this week, we're looking for the manufacturing numbers out of New York for February, and of course, Canada's gross GDP numbers for December and for 2020. They're actually out. We'll touch a little bit on that when we get to the Canadian side of the updates. Stock futures, again, continued to slide a little bit this week. Both NASDAQ and S&P down. Cover a little bit when we talk about the bond rates, or the increase in the 10-year bond rate, and why we're seeing a little bit of pressure on the markets and how that leads more and more into risk. Overall, we're 1 year into the pandemic. Can you believe it? We've been doing these videos for 1 year, trying to keep everyone updated. Not being able to have our live in-person sessions, I think it's been going well. We've certainly gotten a lot of great feedback and a lot of great ideas from everybody as to the information we can host on these things, and hopefully you continue to enjoy them. But we are into 1 year, and things are starting to clear out a little bit. You know, if we look at the U.S. economy, did miss a depression last year. Obviously the recessionary numbers, even in the for a short period of time, but we didn't get into the depression after basically taking a lot of industries completely to a halt through 2020, and now we're going into 2021, and we're starting to see things pick up. I talked a bit in January about the outlook on the travel sector specifically, and where we saw some opportunities potentially opening up there. Definitely in the hotel, and we are seeing from firms like VRBO, which is the rentals by owner, and Airbnbs. We are seeing to see more and more bookings, especially later in the year. I know myself, particularly, obviously not being able to do any international travel. We have been trying to book something in the Okanagan, just, weekend away here and there, and almost everything is booked up later in the year. So we are seeing some, the bluer sky, or we are seeing some better indication that people are looking into more travel, if not the same travel as they did before, but some sort of travel. And that's looking up for the economy to continue to recover. SPACs, if you're not familiar with SPACs, they're venture capital commercial papers that generally are kind of different than what we call IPOs. IPOs are basically, of course, a company's initial public offering. The company will want to go public, so then they'll go raise money out in the stock exchange. SPACs, on the other hand, work reverse. SPACs raise the capital and they go look for a company to take public. So then a lot of people will invest into a SPAC. not knowing what they're going to get in the long run as far as the company goes and the management or whoever's managing the SPACs. They're responsible for finding a good deal, finding a right fit for the company, finding the right opportunity for that particular investment. They've done exceptionally, I won't say exceptionally well. There's been a lot of them in 2020, and some of them have done well. But it's also part of this frenzy, which is that term I've got in there, stonks. If you're younger, or if you have younger people in the family, just mention stonks to the younger generation, and they will tell you it's a meme, just about kind of silliness. The GameStop. If you followed the Reddit stream that drove up the price of GameStop temporarily, well, it's actually running up again. Falls into that stonks category. So anyway, this is kind of just pointing out a bit of overwhelmed enthusiasm in the market around these things. We're seeing some billionaires out there just dropping money into these SPACs, hoping for it to go up, and the deal's going up 25% already, and they don't even have a company to invest into it. So it's just a pile of cash. And it's already gone up in value. So a little bit of over exuberance, a little bit of speculation, a fever happening there, and that's going to lead a little bit more into when we talk about risk. To go electric, of course, America needs more mines, and can we build them fast enough? So we've talked about this, of course, the electronic vehicles. And keep in mind, I think I've mentioned this a few times before, when we talk about electronic vehicles, not just your passenger vehicles, the car you're going to drive every day. Of course, there's a lot more of those coming out. Volvo just announcing, by 2030, 2035, they're going to be completely electric. Toyota's just announced out some new battery technology where they're focusing on electric. Ford, BMW, Mercedes, everybody, and of course you've got the Teslas and the Neos of the world, and a bunch of new entrants like Polestar and Rivian and Badger, which is Nikola, all coming to the market. So a lot of competition in that space, but where we're also seeing a lot of growth, or a lot of push for growth, is on industrial or fleet vehicles. So the heavy trucks, transport trucks, mining equipment, all that area, and that's where we really focus on the supply chain. So rather than trying to pick who's going to be the winner in all this competition, they all need kind of the same components, the same materials to build, regardless of who's manufactured. So we're starting to see this really ramp up. There's this case right now in Nevada, where there's a big lithium deposit, where this Australian firm, Ioneer, who wants to go mine that. But there was this cluster of endangered flowers. So they weren't able to get in there, and all of a sudden the flowers just died and are gone. So now they're hoping they can get in there, and of course there's now an investigation around what caused the death of those flowers. Was it any bad actors doing that just so that they can get in that lithium? But that's a bit of the supply chain demand. There's a lot of demand out there for the metals that go into these batteries, and also the battery manufacturers themselves, as opposed to just the cars. So that's where we like to invest. Hopefully, we're also watching for ethical ones, not ones that are out there poisoning, endangered environmental areas just to get at it, and who mine on a renewable in a renewable manner, and not just kind of damaging the environment around them. But so something to keep in mind, there is a lot of demand building up on the supply chain. U.S. factory activities are at 3-year highs, so it's building pricing pressure. We're seeing this across pretty much all industries. Going back to that inflation story we talked about last week, when manufacturing and surgeon raw materials are in demand, prices go up, and none more so than home improvement type products. A lot of people, I call it nesting, putting money into their homes, because of course they're spending more time there. The family's spending more time there. So people are working at. I was talking to a couple of construction companies that do renovations, in the last few weeks. No, I'm not doing a renovation. I was just simply talking to a couple of the owners. And, they were talking about, plywood a year ago was $19 a sheet, and now it's almost $50 a sheet. So, that just being a simple example of costs going up. But it goes right through to, faucets, fixtures, lighting. Basically, everything is starting to see some inflationary pressures in that supply chain when it comes to manufacturing. So good news on that front, but at the same time, inflation is starting to raise its ugly head there. Democrats, of course, pushed through, the Biden administration pushed through their relief bill for the second round of stimulus or third round of stimulus, depending on how you look at it, down in the United States, the 1.9 trillion. Now they're starting to sift through that 1.9 trillion and trying to decide, maybe we should do this, maybe this is too generous. And one of the things that they're wavering on is that $15 minimum wage rate. So we're going to have to keep an eye on that. Obviously, the Republicans didn't support it. They did push kind of the package through without Republicans, so that could cause problems down the road. So we're going to watch that pretty closely. Bitcoin. Citibank is saying it's at its tipping point. We have seen some weakness in the rally there as volumes kind of went up substantially, or buying volume, went up substantially, driving it. I think it got over the $60,000 US per Bitcoin. We've seen some other cryptocurrencies showing a lot of volatility. And more traders are getting into it. When you have this frenzy, I saw Goldman Sachs, who had shut down their cryptocurrency trading desk back in 2018 after the last frenzy, is just reopening again, feeling they have to take part into this, make some money at it. Well, the more and more this is starting to happen, the more concern we have of, whether we're going to get to a breaking point on the pricing here. So, again, we have a video specifically on cryptocurrency and Bitcoin if you want to go watch that and get more information on that. My opinion, love to hear from you guys, your opinion on it. Of course, it is something new, and there's a lot of risk, a lot of opportunities in there, and a lot of challenges wrapped in all kinds of things, which we've talked about in the past. Brainerd says the pandemic is starting to show a lot of financial systems flaws that need a lot of reform. That's definitely true. The pandemic, the last administration in the United States, governmental administration, that we've seen a lot of flaws out there, and I think it's really on us as a society, if not as people, to look at what we learned through the pandemic, what we saw, what the good things and the bad things, and to improve on those moving forward. And there's been a lot of opportunity for, it's been called the reset button to be pushed, whether it's been on the energy sector to go more environmental, with moving away from fossil fuels more, not just the environmental impact, but of course the cost impact and the longer term impact on economies. The financial sector, the governments have a lot of opportunity to fix things that, obviously came to light that, there's problems and situations that need to be addressed. And certainly our sector, my industry, is no different. GameStop stock, is a great example of that, where, a group of individuals highlighted, I'm not blaming them at all. In fact, they didn't cause this issue. They highlighted an issue that some billionaire, or the hedge fund industry has been exploited for years, and often to the detriment of not just the markets but other investors, and they did the same thing. So they just brought it to the highlight, or to the forefront of discussions. And so I think there's a lot of areas out there that need to be addressed and improved as we move out of this pandemic. So call it a silver lining that we were able to see these issues and have the opportunity now to address them. As far as the COVID-19 here in Canada, obviously continued little bit of stress on the rollout of the vaccine, but does look like it's getting a bit better. We're seeing some pockets of improvements. The estimates I just read, I think it was yesterday, BC talking about by July, the vaccine will be open to all adults, which is better than the previous expectations. Of course, we have the new AstraZeneca vaccine approved here in Canada. Some concerns on that one being not as effective. Remember, that one does not use the mRNA, the new technology that both the Pfizer and the Moderna one uses. And now we have the Johnson & Johnson one coming out, which is a single vaccine, which a lot of people are excited about. And Johnson & Johnson seems to be able to, or ready to put out some pretty high volumes, shipping volumes right away, both in the US and Canada. And Canada actually was one of the earlier ones that signed a deal with Johnson & Johnson pre-vaccine being prepared. So Canada would be eligible to receive a lot of those. So it looks like things are starting to step up. And obviously the optimism in that is moving. I know here in BC, it's March that they're going to mass vaccination by age, starting with those over 80. And Quebec has just opened some max vaccine sites, also going by age. I think they're just finishing up the 80 and above in Quebec and moving, I think the next level is 70 and above. But we're starting to see that pick up. And if what we see in other countries is any indication, once the mass vaccination starts, those numbers start to improve really quickly. We saw it in the UK, which had a really slow start, much like we saw in Canada, and then pick it up. We saw a bit in the US, whose numbers are improving all the time as well. Now, of course, there's the new strains that are coming in, which is a concern as to do the vaccine. Are these effective with the vaccines? Which vaccines are better with the different strains? Still a lot of data flowing in there. Early data says the Pfizer one's better with it, but of course, Pfizer was one of the early ones approved. So there's more data behind it. I think that's going to be a little bit of wait and see. Certainly, obviously, getting as many people vaccinated as possible to slow down the spread, which will slow down those new strains and limit their impacts is the key. So that's what we're moving forward with around the world, and hopefully here in Canada, the numbers keep on improving over the next few months. So let's take a look at the individual economies. The U.S. Still seeing more reported targets expected to come out with a jump in fourth quarter. Pretty much what we saw with Walmart, boosted by higher demand on household goods, beauty products, electronics, anything to improve the home, anything people are using inside the house. They also put a lot of investment behind their delivery system. So that became more efficient and cost effective for them. So the fourth quarter should look pretty good. Much like where we've seen other big box retail stores that mainly deal with consumer staples, right? Things we need day to day, things you want around the house. On the flip side, we got Kohl's reported. We're expecting to see a decline in the fourth quarter. Sluggish demand on apparel. People aren't dressing up as much. It is actually a year since I put on a suit, because just prior to the shutdown for the pandemic, I was in Mexico. I came back early March, and of course everything shut down. So it's been a year since I've seen my dry cleaner with my suits. So people are spending money on those types of clothing, and Kohl's also has a lot of discretionary goods. So the discretionary side of things, people have definitely cut back on, and we do expect that to continue. Even with things reopening, I think the high-end discretionary items, people are going to be a little bit slower coming back to, still focused on those staple goods. The Fed Reserve, the board of governors are getting together to discuss monetary policy, as well as the San Francisco Reserve Bank are having a committee meeting to discuss how things are moving along. And this goes into what I mentioned earlier, that inflation. So we did see the 10-year rate in the US get over 1.5, almost 1.6, indicating inflationary pressure. So as I've said for the last I'll say 6 months, 3 to 6 months, the US Fed, the Bank of Canada, and many central banks around the world have all committed to keep rates low because, of course, you stimulate the economic recovery by keeping rates low. But that's the main quiver or arrow they have in their quiver to fight off inflation, is to raise rates. So they're trying to hold off raising rates, but the market has started to push those longer term rates up, or the demand on those up. So then we get into this playground where they can use language, they can use other monetary tools to try to keep those rates low and try to keep inflation as low as possible before they have to start hiking rates. They originally had the goal of 3 years without hiking rates. I've always said if they can make it a year, I'll be really impressed. And they're still working towards that. So they're meeting again this week to discuss that and how they're going to do, how they're going to maintain that. Obviously, they have new members down in the United States with the new government. And so they're, figuring out their strategies and how they're going to best do that. But we did see those rates creep up. And that's what you're seeing, that pressure on the market in the last 2 weeks is, of course, as rates increase, that puts pressure on growth, especially growth stocks, those speculative stocks. Not all growth stocks are speculative, but those growth areas, they need capital in order to grow. That's just the way it works. And as that costs more, that slows it down, or even the perception of that costs more, because a lot of projects or growth initiatives aren't kind of day one, hey, we're going to go lock in at these rates. They tend to mean investment of capital over several years. And if they think those rates are going to increase substantially, that can affect the viability of that growth initiative. So definitely, we're going to talk more about it when we get into the foreign exchange section here. But that increase, or that drive, was a bit of a scare to the markets because 2020, most of the market increases were in the growth sector, not a lot of what we call the value sectors. We're also seeing J&J, of course, I mentioned, coming out with their stock, their shots. They're ready to start shipping in 1 or 2 days as soon as the approvals come through. And both Canada and the US are in line for some of that. Texas Power Company, of course, if you follow the storms down in the US, we talked a little bit about it in previous ones. So they had the big ice storm, their grid failed, a lot of reasons. So most provinces and states are all part of a national grid, meaning if, BC, for example, some of our main power generation went offline, we could divert power from other parts of the country, even from the US, into our grid. Texas is the only state that is not part of the national grid. They have their own grid, and it's part of them not wanting to be regulated. It was by choice that they did that. They stayed out of the national grid because as soon as they connect into it, they have to follow all the same rules and regulations. And Texas's leaders decided that for years, just not recently, that they did not want to be part of that. They wanted to let the free market handle it. So back in 2011, I think it was, they had a very similar storm, same idea, power, not as bad as this one, but power outages and problems. And there was a big study to say, how do we prevent this? There was a lot of recommendations of upgrading the power plants to deal with cold weather, to deal with these storms, which are expected to frequency to increase massively over the next decade or so. And surprise, surprise, they didn't do it because they weren't part of the national grid. They weren't required to do those upgrades. And in an open free market that they have, competitive market, add in that cost to their clients or to the customers to do those upgrades would mean they put them behind one of their competitors. So none of that was done. So they were hit really hard in that storm. And because it's a free market, basically power is priced based on demand. So here, if we were to go to something like that, that would just mean during main daytime hours, things would cost, or power would cost more than say overnight, where demand drops off. You see that in other areas where people will run their washing machines at night, their dryers at night, because the power cost is cheaper overnight than it is during the day. Well, in Texas, they have that. And of course, that means that prices surged. And we heard stories that, some people who did maintain power through it, I think the worst one I heard was a $17,000 power bill for the month, just to heat their home. And other ones, in the $4,000 or $5,000 ranges. And one of the power companies who were buying power from another producer, Texas Power, the cooperative, wrapped up $1.8 billion in grid debt. And all their clients, of course, are saying, well, we can't afford the $17,000 a month bill or the $5,000 bill, so a lot of defaults. So they filed for bankruptcy. So we'll be looking for Texas, probably going to see a lot of reforms, as this is going to cause a lot of problems. Exxon Valdez has a new CEO, as investors were putting pressures to shift their focus to more green technology, more clean energy. And this is, we're seeing this right across the fossil fuel sectors. These companies, as we've discussed, by 2030, the best estimates was that we were going to see a world decline in fossil fuel demands. Not going away, just an unrecoverable decline, just like we've seen with coal industries decline, and energy's gotten cleaner, energy's gotten cheaper than fossil fuels. And of course, there's the environmental impacts. We're seeing more and more companies and more organizations pushing to work with companies that are more favorable to the environment. So they brought in a new leadership into the company who's going to focus on shifting the company to grow their clean technology divisions and shift more and more of the business towards that, which all in all is a good thing. AstraZeneca just sold a big stake of their vaccine maker Moderna over for $1 billion to an Anglo-Swedish drug maker, just cashing out on the current rise in price. Why not take the profits while things are high? Not to say that the vaccine won't be needed long term, as it's probably going to be an annual thing, just like the flu shots, but so taking advantage of the surge that's out there. United Airlines took a big bet that people are going to get back to traveling for 2023, by 2023, and put in 25 new jet orders, but not any jet, but the Boeing 737 MAX 8s. That was the jet, of course, that had the devastating problems with two crashes that took many lives, and was grounded for over a year as they figured out the problems, and it has been approved back for use again. But United's put their stamp of approval behind it by ordering 25 new ones, and hoping that they will be back in the air at full capacity or better than full capacity by 2023. Coming up in Canada, as I mentioned, the GDP numbers. So they did come through for 2020. We saw, for the year, we saw a 4.5% drop in GDP, one of the worst ever, but not surprising given the shutdown that we saw. The last two quarters we're growing back again, so we are seeing that recovery coming back. It has slowed a little bit, so we are growing, or we are coming out of that slump early last year, but at a little bit slower rate than things were hoped for. Endeavor is pivoting to exploration to shake M&A junkies. Images after a deal spree. So Endeavor Mining, the gold producer, is about to list their stock on the London Exchange. They just spent $2.7 billion over the last little while doing several acquisitions in West Africa, and now they're going to just sit back and focus on incorporating all those, streamlining all those businesses into an integrated firm. So that one we're looking to pivot away from buying more and more companies and become more of a mainstream gold producer. And as always, we talked about gold being a great inflation hedge. CAE, which we've talked about several times, we've had it in the portfolio in the past. Recently moved out of it prior to they had a bit of downturn as their civil aviation, so their simulators that they train pilots on saw a slump, of course, in 2020 with the slowdown in travel. What do you call it? Vacation travel. Sorry, my apologies. But they just signed a big contract for the military training simulators. So good for them. So they're seeing a better outlook for 2021. The Canadian factory activities accelerated on that vaccine optimism as well. Much what we've seen in the US. There's a little bit faster. Of course, they didn't shut down as much as Canada did, but on the vaccine optimism, we're starting to see that pick up. And then 6 weeks, 6-week sprint into the Indian-made AstraZeneca approval into Canada, as I mentioned, that's been approved now in Canada. We'll start to see that one come in. It seems though that the Canadian administration is more excited around the Johnson & Johnson one, and as I mentioned, they did sign an early deal with Johnson & Johnson for their vaccine availability. So that one might be the one we see come through sooner than later. On the foreign exchange, the euro fell a little bit against the US dollar, and that's just on that gap that they talked about, the government bond yields, the 10-year government bond yields moving a little bit. We're starting to see inflationary pressures over in Europe as well. So the same concerns we're seeing over here, which opened up that gap a little bit. And really, this is something we're going to watch really closely. We did see I mentioned it got to about 1.6 in the US. It's down to about 1.43 now on the 10-year yields, which is good. It was at a low of below 1 in January 4th at the beginning of the year. But I think if we get to the 1.18 range, that's when we're going to see some real danger for growth around the economy. So we do have some buffer room. It has pulled back here. And hopefully we, as I said, the US Fed and the Bank of Canada can use other tools rather than interest rates to stave off inflation. Because as soon as those rates start to move, we will start to see things shift. Again, it all comes down to unemployment and those numbers. And I think as things reopen and stimulus packages start to unwind, we are going to see that that real damage in the economy. Here in Canada, of course, we still have very high unemployment rates. The US, the unemployment rate is dropping. Again, not at the numbers that we'd like to see, but it is dropping. But it's really not to the levels that would bolster the economy into growth mode. So we really need to see those continue as we reopen here. On the oil front, we did see it slide down a little bit. Still staying strong above 60, so still doing well as far as the sector goes. We are coming up on an OPEC plus meeting, so OPEC plus the extra group of countries. They got together last year to turn off or really slow down production around the world as demand had fallen off. A little bit of concern that some of those countries are going to start opening the taps back up again a little bit too soon before demand really starts to increase. So that's something we'll have to watch. If we do see supply start to increase faster than demand, of course, that's going to put a pressure on the pricing. The goal of the OPEC plus meeting is to keep the countries to hold off on that, but we'll have to see the outcome there. And gold ticked slightly lower, not much a move, just as we see a steady decline in exchange traded funds, see strong outflows. But that's mostly on, I would call that a patience factor. What we've seen is, gold had a really good mid-2020 move on the stimulus packages, on the inflation fears. And then it stagnated a bit for the last half of 2020 and the early part of 2021. And we've seen some people, just see growth in other areas. So they've left that, or we're seeing the outflows of investors from that area. But really, because we saw that growth, that's just inflation in another form. So we still see gold as your best inflation protection for 2021, and a great exposure. Just keep in mind how much exposure you have, right? I mean, we have a couple percent in our portfolios right now. We're likely to increase that when we start to see movement again. But just be cautious. So you don't want to have gold as 10, 20, 30% of your portfolio. If especially if you're playing it as a hedge, it is still a commodity. So with that, let's talk about risk and what that means. And you've heard me talk about inflation risk. You've heard me talk about market risk, but really, a lot of people I find when we say risk and invest in, maybe a little bit confused as to what that means. Of course, there's the underlying risk of any investment that you particularly buy, what that company's doing, or what the underlying fundamentals are that are moving the price or the return of that investment. But really, risk is all about that. Be cautious of where you step, know where you're going. If you remember when I talked about the market bubble, really understand why you're investing into something and what that means, not for the past year, but the year ahead, or even the 6 months ahead. And this goes back to that buy and hold strategy that was popular in the 90s. And this was a chart we saw all the time, saying, okay, well, if you just held on to your companies, as long as they were good companies, if you had just held on and you waited through the market, you would do better. The performance over the long term would be better versus just missing the 10 best weeks, right? So this is looking at a 15-year period. If you just missed the 10 best weeks in 15 years, you underperformed dramatically versus if you just went for the full ride, which is 100% true, except for what they don't look at when it comes to risk is what if you missed the 10 worst weeks over that 15-year period, right? So what if you didn't stay fully invested, but you just missed the worst periods? That doesn't mean you got out at the high and bought in at every low. It just means take out the 10 worst performing weeks and you weren't in there. You would dramatically outperform the buy and hold strategy. And that just goes to understanding what the fundamental risks are in the markets. And the underlying market fundamental risk in the markets is correlations, right? What's driving things to go up? What's driving things to go down? Sometimes it's something within a single investment that you're making yourself. So you're buying into one particular company. Something happens inside that one company and it might go down. But a lot of times the risk is market weighted. So something's happened in the sector or something's happened in the economy that is affecting things negatively. And even though the company you're invested into might not be directly affected, it is being positively correlated. I mean, it's being dragged down along with other things. And that's the risk we can actually work to avoid in the portfolios. And I've always talked to people about it, that diversification, it's often called 60-40 balance, how it doesn't work, because its premise is that, for example, if bonds are going up, stocks go down, as I mentioned, as yields go up, as the cost of money increases, growth goes down. So bonds should go up while stocks go down, and when stocks are going up, bonds should go down. So by putting in that, historically, a lot of portfolios have put this buy and hold and say, well, if you just have the right mix of those two, 60% equities, 40% stock, or fixed income, you would be protected. But we're really talking about a three-dimensional risk in today's efficient markets, because a lot of things have changed since that original theory came out in 1952. Markets are much more efficient. News flows a lot faster. Trading is more efficient. We have logarithm, we have bots out there trading. All these things drive to a much more efficient market. And what we've seen over the last 20 years is this third dimension of risk, which is correlation, which when things start to go down, everything starts to go down. Bonds go down along with stocks. Nothing's really protected. And that's when we see those correlations start to become positive, when we start to see, you know, something like bonds and stocks, which normally act completely opposite of each other, start to positively correlate. That's early stage of risk building in the market. And it's important to adjust your portfolios when that starts to happen. And we're 100% starting to see the early stages of that happen. And that's why I caution people to take, you know, a close look at that. Because a lot of times, you know, if you think you're protected in a portfolio that says, oh, well, we're going to average this amount of risk, you know, when we talk about risk, we talk about volatility. So, you know, a conservative portfolio of 6% volatility, or a medium growth portfolio of 8% volatility. And I can't believe we have to actually go back and look at the bubble of 01 and the financial crisis of 08, but that's kind of the ranges we're seeing right now. Is you know, during those times it might average a 6% risk or an 8% risk, but there are periods in there in any average that it's much higher. And in fact, in 08, in a conservative portfolio of a 6% risk, average risk, it actually peaked out at almost 20%, right? And during the same period in a growth portfolio, at almost 35%, it peaked out. Yes, it averaged 8 to 12 over the whole time period, but there was that peak period. And if you can avoid those peak periods of risk in the markets, you will perform a lot better. Many of you have heard me say before, if you have $1 million invested and it goes down by 10% and then comes back up 10%, you are not at break even again, right? Because you only have 900,000 working for you at the bottom after it's gone down. So you don't get back to the full million again. However, if you have $1 million working for you and the market goes down 10, but you only go down 2, you don't even have to have the full 10% upside in order to get back to break even and new profits again. So really important to protect in downturns. Be cautious, be aware of the risk in the portfolios. I think in today's markets, more and more we need to be aware. Doesn't mean go to cash and stuff it under your bed. There's still opportunities out there, but just be really aware of the risk out there. And be cautious of your long-term plan. 6 months doesn't mean a lot in the long term, especially when you're talking about risk. And you decide what's the right risk for you, right? You know, maybe you're willing to take a little bit more. Maybe you know, you just see that as something you really don't need in your life. So with that, as always, whether you're with us live, you're on the replay or on the podcast. If you want to talk about risk in your portfolio, give us a call. Go to mikeonmoney.com. We're happy to walk you through your portfolio or review your portfolio. If you have questions about another one, to make sure that you're at least aware of everything that's out there. So with that, I'm going to call things for the day. I look forward to talking again next Tuesday. We did put out the video on the flow through shares last week. And we'll have one coming up for you this week on a deep dive topic. And as always, send us in your ideas or anything else you'd like to share with us. We love talking to you. So enjoy your week and talk to you soon.